Do you know about the September effect? If not, you might want to start paying attention. In this video, we'll delve into what the September effect is, why it happens, and most importantly, what you can do to navigate through these uncertain times. But before we dive in, don't forget to hit that like button, subscribe to our channel, and ring the notification bell to stay updated with our latest insights. Now, let's unravel the mysteries of the September effect and equip you with the tools to weather the storm. The phenomenon known as the September effect is a puzzling historical quirk in stock market performance. To understand it better, let's dive into the historical factors and economic activities that have contributed to this curious trend. Historical performance oddity. Historically, September has earned a notorious reputation as the worst performing month of the year for the stock market. This may sound counterintuitive, especially in a world where financial markets are expected to operate efficiently, meaning prices should reflect all available information. However, stocks consistently seem to underperform during this particular month, defying the expectations of efficient market theory. This peculiar pattern of underperformance has been documented on performance charts dating back to 1960. The data clearly illustrates a stark contrast between the disappointing September returns and the more favorable months of October, November, and December. In fact, this unusual trend in stock market performance has become so well known that it has earned its own name, the September effect. Remarkably, this phenomenon has persisted for nearly a century, leaving experts and investors scratching their heads. Economic activities in September. To shed light on why September behaves differently from other months, we need to consider the economic activities that tend to occur during this time. Historically, significant economic events and occurrences have unfolded in September, which has had a noticeable impact on market dynamics. These events often include key financial milestones and announcements. It's essential to note that the negative sentiment associated with September isn't purely coincidental. Several factors have contributed to this phenomenon. Number 1. Market crashes. In the past, some of the most notable market crashes and downturns have taken place during the month of September. These crashes can cast a shadow of uncertainty over the financial landscape and impact investor confidence. When investors are wary, it can lead to a self-fulfilling prophecy of poor market performance. Number 2. Quarterly financial reports. September marks the end of the third quarter for many companies. This timing often leads to heightened scrutiny of corporate financial reports and earnings. When companies fall short of expectations or issue pessimistic forecasts, it can trigger negative reactions in the stock market. Number 3. Investor behavior. Institutional investors, such as mutual funds and pension funds, have a habit of selling off assets towards the end of September. They do this to lock in profits and position their portfolios strategically before the year end. This behavior, known as portfolio rebalancing, can have a noticeable impact on the market's overall performance. Before we continue, if you're finding this information valuable, don't forget to show your support by hitting that like button and subscribing to our channel. Your engagement helps us keep bringing you valuable insights. Now, let's get back to understanding the September effect. Hedge funds and their influence. Hedge funds, known for their sophisticated investment strategies, play a pivotal role in shaping market dynamics, and their behavior can significantly influence the September effect. Number 1. Record high exposure to mega-cap stocks. One key aspect contributing to the September effect is the extraordinary level of exposure that hedge funds have to mega-cap stocks. These mega-cap stocks are typically associated with the largest and most influential companies in the market. Hedge funds, driven by the potential for high returns, have increasingly invested in these mega-cap giants. To put this in perspective, consider the Magnificent Seven tech stocks, including companies like Microsoft, Apple, Alphabet, Meta, Amazon, Tesla, and Nvidia. These companies collectively represent a substantial portion of the stock market's total value. Hedge funds have shown a remarkable appetite for these tech giants, with their investments reaching all-time highs. This means that a significant chunk of hedge fund portfolios is tied to these mega cap stocks. Number 2. Vulnerability to bubbles. The overexposure of hedge funds to mega cap stocks, particularly those associated with emerging technologies like Nvidia, has raised concerns about the potential for market bubbles. A bubble occurs when the price of an asset significantly exceeds its intrinsic value, and it can lead to a sudden and sharp decline in prices. Nvidia, for example, has been closely linked to the AI artificial intelligence frenzy. While AI is undoubtedly a transformative technology, the rapid price appreciation of Nvidia's stock could potentially be unsustainable. If investors perceive that the stock's value has become disconnected from its true worth, it can lead to a market correction or even a crash. This vulnerability to a potential bubble burst adds a layer of risk to the market. Number 3. Market sentiment and investor behavior. The behavior of hedge funds and their massive holdings in mega-cap stocks can influence overall market sentiment. If these influential investors start selling off their positions, it can trigger a domino effect, with other investors following suit. This selling pressure can contribute to market turbulence, especially during the traditionally sensitive month of September. Now, let's talk about market exuberance. Market exuberance refers to a state of heightened enthusiasm and optimism among investors, often fueled by the belief that stock prices will continue to rise indefinitely. Market exuberance can be infectious and lead to speculative buying, pushing stock prices to levels that may not be justified by fundamentals. Number 1. The Magnificent Seven and exuberance. The enthusiasm surrounding the Magnificent Seven tech stocks, which include some of the most influential companies globally, has contributed to market exuberance. Investors have piled into these stocks, believing in their growth potential and the allure of emerging technologies like AI and digital transformation. Number 2. Potential for market correction. While market exuberance can lead to short-term gains and euphoria, it also raises the risk of a market correction. When stock prices becomes disconnected from their underlying fundamentals, a correction can bring prices back in line with reality. This correction can be particularly sharp if it coincides with other factors, such as hedge funds reducing their exposure or concerns about the broader economic environment. Now that we know about market exuberance, let's shift our focus to student loan payments. The resumption of student loan payments in September is another factor contributing to the September effect. Approximately 40 million Americans hold student loans, and they haven't had to make payments since 2020. However, rising inflation and living costs have put a strain on people's finances. Accrued interest starts piling up in September, and loan payments are set to resume in October, causing financial stress for many borrowers. Alarmingly, nearly half of student loan borrowers anticipate going delinquent when payments resume. This financial stress on consumers can lead to reduced spending, affecting businesses and potentially triggering a deflationary spiral with far-reaching consequences. Next is the banking sector concerns. The banking sector is facing its own set of challenges, which could exacerbate the September effect. Regulators are pushing banks to increase debt levels, and some banks hold massive unrealized losses from their investments in treasuries, made when interest rates were near zero. As interest rates rise, these treasuries have become losses on their balance sheets. If depositors become aware of these unrealized losses too quickly, it could lead to a rapid collapse of banks, similar to what was observed a few months ago with SVB and company. These banking sector vulnerabilities add to the overall concerns contributing to the uncertainty surrounding the September effect. Okay, let's answer the million-dollar question. What to do during the September effect? The September effect, characterized by historically poor stock market performance and various economic concerns, can leave investors feeling uncertain. While it's important to remember that past performance doesn't guarantee future results, here are some strategies and considerations to navigate this period. Diversify your portfolio. Spread your investments across different asset classes to reduce risk. Diversification can help mitigate the impact of poor stock market performance in September. Stay informed but avoid overreacting. Keep up with the economic and market news, but resist making impulsive decisions based on short-term fluctuations. Emotional reactions can lead to poor investment choices. Review your investment goals. Assess your financial objectives, risk tolerance, and time horizon. Make sure your investment strategy aligns with your goals. Short-term market fluctuations may not be as relevant if you have a long-term perspective. Consider dollar cost averaging. Use a systematic approach like dollar cost averaging to invest a fixed amount regularly, regardless of market conditions. This strategy can help mitigate the impact of market volatility. Seek professional advice. Lastly, if you're uncertain about your investments or the impact of the September effect on your portfolio, consult a financial advisor. They can provide personalized guidance tailored to your situation. Thank you for joining us on this journey through the fascinating world of the September effect. Before we wrap up, we've got a thought-provoking question for you. What's your strategy for your portfolio this upcoming September? Share your plans and insights in the comments below. And don't forget, if you've enjoyed this video and want to stay in the know about all things finance, make sure to give us a big thumbs up, subscribe to our channel, and hit that notification bell. Until next time, happy investing!